Warriors, welcome to Wicked Wednesday. And I'd say the dollar was pretty wicked to all the dollar bears here. You know, they've been waiting for a 95 breakdown. They got it. I actually saw this as, at least short term, a false breakdown. Now I think that this might be it. You know, all the people that got short the dollar, they're probably gone now, when really all you're doing right here is retracing about 50%. Maybe we get to 560, but now I'm leaning into the short side of the dollar, starting off with some long euros here. They took out some stops, took out this low where, you know, people thought they had it going. This too, you know, diverged just like the dollar did. And, you know, maybe it's just an ABC and the dollar euro digs in its heels between here and 15.20, 15. So giving that a shot. Everyone doing okay today? All is well, Forex gal. So on Monday, talked about that if the market rallied, I'm talking indexes now, that bear market rallies, and write this down, they're vicious, they're sharp, and most importantly, they're not long lasting. So I don't know if this was all of it. My instincts tell me it's not, that we'll get a pullback, we'll make another attempt up here, but I'm still viewing this as a bear market rally. You know, I was thinking about something. I used to trade options, mainly, you know, like most of the chumps buy them. And how many people do you think bought October puts looking for a crash this year? Well, you know what? They expire this week. And the option writers, the put sellers, are starting to take the premium back away from them. So I'm thinking this could probably last into option expiration. But the reason I know that is because, you know, I'd been in many option trades where, you know, the market will hold together until expiration, and then the move that all that open interest was looking for happens after the expiration. These guys are like casinos, okay? They're like the bookie, and the bookies, you know, they lose once in a while, but not very often, or they'd be out of business. So that's something I thought about with this being the third Friday coming up in option expiration. And most participants were looking for, you know, if there's going to be a crash, it'd be in October. So the simple strategy was to buy October puts, and, you know, if they didn't ring the register. And if you do trade options, I have a tip for you. Anytime you have a double, you take at least half off the books. You'll take Ohio State with the points. Who are they playing? Joe? Purdue? Oh yeah, pretty brave bet. Although Indiana gave them some trouble, didn't they? All right. So besides that happening, you know, gold is acting toppy, but it hasn't completed its mission. You know, I think there's one more drive left here. You know, there is some selling pressure coming in here, but to me on the 1 hour, you didn't make a third drive because we failed from that high. So it's still incomplete to me. Think there could be one more high, and maybe part of that is what I was talking about earlier, which was maybe the dollar coming off and assisting gold towards reaching its objectives to the upside. When I look at yields, they've come off, but it certainly hasn't been impressive. Starting to like the way EG is shaping up. Scalped it a few times yesterday. It's almost making me think, I know we're going to get at least back to 840, the breakdown 850. But Saeed was on and he said, you know, we get back above 85.50, you have something. So it did hold some type of fib that I can't read down here at the 46 level. And it still is a higher low when you go all the way back to the 86.20. It's probably like 78% back, but keep an eye on this one. Closes back above the 88.40 level is going to trap a lot of people. Everyone here who got short, I'll admit, after this day, I was buying pullbacks, and scalping, but eventually proved wrong here. Is there anything else that I'd like to? Oh yeah, I was looking for a rally in the yen, and we got it. But with that type of intense rally that we had, NASDAQ up 200, Dow up 500, so it's really not that impressive. The only constructive thing I could think of, if we're not going to break from here, for it to be more constructive would be for it to correct this bounce, which was about an 80 pip bounce, and pull back 50 and maybe put in a right shoulder at 1185 and then make a move higher. So we'll see how that plays out. I'm interested in hearing what Blake is thinking here this morning, and I'm wondering if he'll do me a favor and give me the count off his triangle in the S&Ps to see if we're close to fulfilling what didn't look likely yesterday. How about it, buddy? Would you do that? Would you do that for an old man?
Oh, God, since you asked nicely, I guess.
Okay, I knew it. I'm doing good, buddy. Good. How about yourself? How's it going?
Good. I'm doing all right. I've got I pulled a decent trade off the Kiwi overnight, and I shorted it at 65.80.89 because we were sitting at the 618. I had more to sell above 66, but that never got filled, and we were looking for it to fail in this channel. So
nice.
Yeah, I mean, if you're this is a very well,
sometimes it doesn't get to the line, does it? And people will wait and wait and wait and miss it, the whole thing. Yeah, I mean, you have to be open-minded and flexible. That you can't be a technical analist, if you know what I mean.
I know exactly what you mean. But it's one of those things that if you're extremely and good morning, Stelios, if you're extremely diligent in looking for your precise entry points, you're gonna find less to do. You're gonna take less positions. That's just the bottom line. You're gonna take less positions. But the positions that you take are probably going to be very well executed. So there's that. And if you let your discipline slide a little bit, like I did last night, then you will be able to make some trades here and there, and but you're also exposing yourself to higher risk. So for example, I had one of two situations. I could have just kept my order at 66.10, which never got triggered, so I would have not made any money today. Okay. Or I took a half size position, which I did last night at 65.90. I ended up closing it at 65.66. So really close to where we're at right now. And I made a few bucks. But the flip side.
Yeah, you reacted to what the information the market was giving you.
Well, the flip side to that would have been, if it would have gone against me, because all my stops are above 40. So I had stops. I had stops for not only this position, but this position as well. I would have taken a much heftier loss if it would have completely gone against me, which was a risk last night. I mean, you saw what the NASDAQ was doing and what risk appetite was doing yesterday following Netflix earnings. There was a risk that it could have gone right through this channel. But those are the calls that you have to make when you're in the moment. And last night I was in the moment saying, I'm going to take a small position here, and then and I usually leg into positions because if I see a big technical formation like this, I will try to leg into it if I'm not in front of the screen at that moment in time. So when that happens is when I'm sleeping. So when I'm awake, I can be a little bit more disciplined and looking for those precise entries. But you know, last night obviously I'm like, okay, well, this could all happen and unfold overnight, so I've got to be prepared for it. And that's why I only took a half-size position versus a full-size position last night when we were at the 618. Well, one of the failures here was that the New Zealand had failed to rally from the CPI numbers more than 24 hours. So we spiked up here. This spike happened following the CPI data. We couldn't take it out in North American trade, even with stocks as strong as they were. So I thought that the probability was high that it would roll over, and it did. But I just didn't have as big of a position as I wanted. Now, I did the same thing with the Euro Yen, except I am short the Euro Yen full size now. We have been failing up here at this 130.50 level quite a bit this whole last week, and this is another situation where we had a risk on type of currency that was not responding yesterday to the rally and risk. Exactly it. And
like the yen, Blake, you know, but the currencies, maybe they're smarter and less manipulated because they're so big. It's such a big market than stock market. I mean, the yen should have been up 80 yesterday.
Well, if you guys follow me via Twitter, you know, my tweet yesterday was the FX market isn't doing anything regarding the equity market rally, nothing. And then this morning I tweeted, it said it didn't pay much attention to yesterday's rally, but today it's taken notice. Well, the reason why I tweeted that is because I'm sitting here shorting the Euro Yen yesterday. I shorted at 130 and it just didn't do anything. It just sat here. And then overnight it broke through this channel support. And then I added to it when it was up at 129.55, 59 or something like that. And then so now I'm a full position size short. And if you use ForexAnalytix, you got the analysis last night in Asia, right here, that it broke through that channel support.
Nice.
Yeah, you got the Asian update right there. Because I let everybody know, like, look, it's starting to break through. But you know, everybody in the chat room,
a lot of people don't know that they don't have to be at their platform to have known about that with our mobile app, you're pushing alerts, and they could have been doing anything and gotten that alert.
Yeah, okay. that went out last night. You know,
you were working late.
I updated it 8 hours ago.
Okay.
Yeah, so right there, and you know, these updates you get throughout the course of the day, and you get them via mobile and everything else. But everybody knew in the chat room yesterday that I was short the Euro Yen. I just was adding to it today, and so now I'm in a full size short position. And I think the risk is if equities do pull back, which I'm going to talk about the S&P because you asked about it. If the stock market does pull back, the Euro Yen is at risk of breaking through 129. And I'll tell you what, if we break through 129, which is a 50% retracement, we're going to trade down to 128 pretty quick. So again, these are just, you know, if you follow me via Twitter, you only get 10% of what I'm thinking. If you're in the chat room, you're getting probably about 70% of what I'm thinking, because I'm chatting there all day. And then because at night, you know, I don't always pop into the chat room at night because I'm trying to be a family man, and you know, I'm mobile. And
you are a family man. You're not trying to be.
Well, I try to be. I try to play backgammon with, you know, my wife and kids last night.
Yeah.
And, you know,
you're like a father to me, Blake. You're like a father to me.
You know what? That's funny.
You're like a grandfather to me.
You're like a brother.
But thanks, guys.
A younger brother.
Younger brother with another mother. All right. Let's take a real quick look at the S&P because Dale asked about it. So we had that triangle breakout yesterday. So you know, you know, and by the way, I did lose money shorting the NASDAQ last night. I tried to short it towards the end of the day, right around here. this channel resistance right here at 72. This is in my own personal account. I tried to short it here, and then I stopped myself out, you know, up here. I couldn't. Even though that I knew that we did an ABC. I didn't want to risk the. You know, I didn't want to risk the chance of it
50
continuing.
points.
Yeah, I can't sit in that kind of stuff. Not, you know, I'm just not going to do it. But you know, you talk about the S&P though. So the S&P, I mean, we knew it was going to rally. It came out of this triangle, and so we talked about this yesterday, right? So
yeah, well, what I was interested in is that range from there to there, right?
Yeah, you
and then add it to the breakout, the first one, and where would that take the S&P?
So you have this one. This is the mid of the. You take where we touch there.
Okay.
Point. So this would be target number 1. This would be a full extension target number 2.
2850, 44. Okay.
Yeah. So the 2820 level was where it got to the first extension, and I agree with you wholeheartedly, Dale, is that when you have a squeeze, a bear market rally,
their eyeballs were popping out. They were getting squeezed so hard.
Yeah, they are convincing. They try to get everybody long again, thinking that we're going to hit all-time highs. They're typically shorter lived, but they are very violent. And so when you're in a bear market, these short squeezes, as you can see yesterday, are extremely violent. And so, you know, if you're going to fade them, you have to, you know, have a little bit of some deep pockets and try to be, you know, precise on your entries. And I flubbed that up myself. I really messed it up myself yesterday. When I faded the NASDAQ, you know, ahead of Netflix's earnings. But, you know, if you're trading the S&P, you would have probably been a little bit better shape. You know, we did fail at the 50% retracement. So that, you know, as you fail at like a, you know, anything less than a 618, so it's a 38% retracement, 50% retracement, 24% retracement. The risk is that we can actually move back to trend lows and come potentially even further. So once you start getting to the 618 retracement, then that's when I start going, okay, well, here, I'm going to draw this out for you. So here's the 50% retracement. If you get to the 618, then I start thinking that we're in a consolidation. Okay. If we, oops, shoot, I didn't mean to do that. If you only hit a 50% or a 38% or a 24% retracement, then I think the risk of continuation is still pretty high. So once you surpass a 50% retracement, then I start thinking, okay, it's going to be like a longer term consolidation before breaking down or a reversal, you know. So because we didn't even achieve the 50% retracement, I still think that the risk now is that we revisit trend lows. You know, I think this is all doable. So you have to think about that moving forward in the S&P. Does that mean you should short it right now? Probably not. I think you probably get some better prices today, especially ahead of the FOMC minutes. Now, the FOMC minutes, I had a question from Amanda wondering if they might tweak the minutes ahead of, you know, if they might tweak them because they might buckle to, you know, President Trump's rhetoric. And the fact of the matter is they're meeting minutes. It's not a live meeting. In a live meeting, it'll be interesting to see what and how the Fed governors respond in the next meeting, because what they talk about might reflect more of, you know, Donald Trump's rhetoric. And if you see any Fed governor start to bend, like they you know, like you see them start to tweak more dovish, it might, if we haven't seen any deterioration in data, it might let us believe that maybe his rhetoric is really influencing the Fed, which it's not supposed to do. They're an independent, you know, organization supposedly, but the minutes are just recorded minutes. I mean, it would be extremely illegal and unethical if somebody went out and started dicing up the minutes and giving us something that that wasn't said, or maybe omitting things that were said. So that's just not going to happen. Not at the Federal Reserve. I wouldn't think. If it did, I would absolutely 100% be floored and shocked and lose all faith in our system. But that's, I don't believe to be the case. So what we should be paying attention to is next month's the next meeting minutes, which I have to go back and look at. Stelios, do you know when the next Fed meeting is?
It's December, right? Hold on.
I think it's December, the beginning of December, the second week in December, if I'm not mistaken, but I'm not 100%
14,
sure.
15, I think. Hold on, 14th, 15th of December. Let me just double check. Oh, sorry, we have one in the middle. We have one in early November.
Oh, we do. Okay, so early November,
but there's no statements or whatever.
But the minutes will come out around Thanksgiving holiday in November, and those will be the meeting minutes that we really have to pay attention to, because we got to listen to what the Fed governor said, how, and like I said, if our data continues to be strong, which for the most part we haven't seen any deterioration in U.S. data. If the data continues to be strong and the Fed governors all of a sudden start to get dovish, then you might believe that President Trump is having an influence on the Fed, and then that's when the dollar will absolutely get destroyed. So if you like right now, the minutes should read hawkish. Everybody's expecting them to read hawkish. And I don't think it's going to be much of an event today. I think that, the dollar is already showing, signs of life. And the dollar yesterday, as Dale pointed out, we had a false breakdown. Well, we also if I'm going to go to ForexAnalytix here. If you read the basic technical analysis last night that I wrote, it says that dollar index hit a new trend low but closed back where it opened, possibly leaving a false break lower. In addition, we came very close to the 618 retracement as well. So basically, we did a false breakdown overnight. You shouldn't have been short the dollar index, not overnight, not if you read the ForexAnalytix analysis from last night of the false break, the possible false break. And now,
Blake, I tweet that a lot, that if people enjoy face and get value out of face, that it's really just the tip of the iceberg, and that they should look beneath the surface. You look at a car, it's beautiful on the outside, you still open the hood, and what happens after face is really the core of what it's all about. This has just introduced people to us, but beneath the surface is where everything is.
It is, and I think the ForexAnalytix and what we have here from if you're trading the dollar, anything remotely to the dollar, and you get up in the morning and that analysis, we push evening analysis probably right around 6 o'clock Eastern Pacific, or Eastern time, 6 o'clock Eastern time at night. So that basic technical analysis comes out around then. If you trade Elliott wave, well, the analysis typically comes out in early European hours, and you can go, if you wake up like when I do, and you go, okay, well, I'm going to go ahead and read through, and the macro updates have been updated. I'm going to read through the different types of analysis and get a feeling of what the dollar is doing right now. And it's a great way for anybody who is not up to, if you've stepped away from the computer for 12 hours to get a feel for what the market's doing. And then you can jump in the chat room and start to get a live feel, because that's where everybody like myself and everybody else is at, chatting about
Blake,
what's
I know
happening.
you're showing your live trades there. I mean, you're talking about them. Amanda's talking about them.
Yeah.
Steve is in there a lot. Stelios is in there a lot. You field questions from members too if they ask you, right? So they have the ability to pick your brain for hours and ask a question.
Yeah, I don't urge that.
I know.
But people step in there and they'll, people, ask me some questions about things, and if I see the question I'm going to answer. I'm in there sharing my ideas, what I'm thinking, and not all my trades are there because a lot of things happen at night. I shorted the Kiwi last night, and I wasn't in front of my computer, so it's like I knew where I wanted to be short. I knew it was stalling at that level, and so I took a position. I told everybody this morning, I'm like, hey, listen, I shorted it last night. I'm covering it up here. That happens too, but that's what we're not all sitting in front of the computer 24 hours a day. It's just not possible. But trying to sleep 4 to 6 hours a night, and then trying to spend time with our friends or family, that does take up at least 12 hours of the day or close to. And so not everything is in there, but like from here, the time I get off of this webinar till the time the U.S. equity markets close, I'm pretty much in that chat room, and I'm also piped into my office in Connecticut as well. So and obviously I got to field some calls and meetings in between all that stuff. So, but there's so many people in that chat room throughout the course of the day. So many great traders. And I'm not just talking about Amanda or Joe or Paulie. I'm talking about, or Steve or Stelios or anybody from our team. I'm talking about just the plethora of just traders that are so much knowledge in there and so many great ideas, and everybody's just really cool with one another. So anyway, and I don't need to point out any one specific individual because there are so many in there. But anyway, going back to today's conversation, we do have the Fed minutes coming up, and the dollar's already got a bid going into the Fed minutes. So I don't know how much follow through the dollar is going to get, but I'll tell you what, if I was long the euro dollar, I'd be a little concerned right now. I mean, we just took out some support. It looks like the euro could revisit sub 115 levels. I don't think this is too far out of the realm of expectations today for the euro, especially if the FOMC minutes read fairly hawkish. How the equity markets are going to respond to that, I don't know. I think there's one camp that says that the Fed's bullish on the economy, so that's good for stocks, and the other camp will say oh, the Fed is hawkish, so that's bad because rates are going to continue to tighten, and so therefore stocks are going to continue to come down as rates go higher. So but what I would be keeping my eye on today, frankly, is not necessarily the stock market or even currencies at this moment. What I'm really looking at, and especially following the meeting minutes, is I'm going to follow the bond market. We've been watching the 10-year. And let me go over to the daily chart here. We've been watching the 10-year for a while, and we are consolidating pretty tight. And I think the bond market's going to tell us a lot about today. So, if the 10-year, which since we're outside of this channel, and this is a pretty big breakdown here. Let me. I'll keep that, but let me grab this. This is this is a resistance zone, right? So yeah. You just put it something like that. If the bond market starts to rally, that's going to signal to me that the market might be a little risk off. Now, you may say, well, if bonds rally, yields are going to go down, so maybe stocks will like that. I think the bond market rallies because it's more worried about risk appetite. So that's what I'm going to be watching today. I'm going to be watching the 10-year and just keeping an eye on that through the Fed minutes. So with that being said, I'm going to pass it over to my colleagues, Steve and Stelios. And don't forget, guys and gals, if you don't get paid for your trading, if you don't get cash back for your trading, make sure that you talk to our sponsors. They're Forest Park FX. They're right here. They have our reimbursement program. So if you're not in the U.S. And you're in Europe or Asia or somewhere else, maybe South Africa or wherever, you can get reimbursed and get ForexAnalytix for free and join our community. But at least get cash back. So talk to them, and all their contact information is right right here. And I'm going to pass it over to my colleagues. So thanks, guys.
Good luck to
Hey,
you.
Blake.
Hey, good luck today,
we just
guys.
got some numbers. We just got some numbers out of the US. Building permits, housing starts a little bit weaker than expected. Nothing massive. So I don't know if
more or less as expected.
And just remember with housing, guys. I mean, this is global. You know, as rates go higher, house prices are going to come down. I mean, it's just it's a teeter totter. Rates go up.
Absolutely. It's basic supply and demand. You make the prices of credit more expensive. That means, in essence, that you make the houses more expensive. The demand is going to go down. And as it seems, Blake, I've seen that there is a lot of stockpile of unsold houses that has been gathering up. And, you know, we've seen that before in 2008. And, you know, initially, I'm not saying that this is, you know, 100% an indication of a recession that is coming, but two things are for sure. First of all, home builders have had some horrible months in having to do with stock prices. Same happens with all the car manufacturers in the US. And at the same time, we get a big stockpile of unsold houses. Initially, when that happens, you see that sellers are actually not capitulating. They're not trying to take down prices because, you know, initially they're hoping that perhaps the houses are going to be sold in the prices that they were initially asking for. But at some point, you know, if this resumes, then you start seeing you know, a depreciation in the prices because everybody's trying to get their
you will. You'll see depreciation, and that's inevitable at this point as rates go higher. You're not going to see a capitulation because you just don't have credit issues like the way that we have had in the past. So you're not going to see people hitting the bid and filing for bankruptcy and foreclosing on homes, not as aggressive as we saw back in 2007, 2008. Is a house price correction coming? Yeah, but the problem with, you know, correction in home prices is, you know, really the fact of the matter is the biggest investment for most American homes is most American families is their home. So when house prices go down, you just don't feel as wealthy as you once were. So you go, oh,
reverse wealth effect.
Yeah, exactly. Oh, I had a $1 million home and now it's only worth $700,000 and I still owe, you know, $300,000 on my home, and I had $700,000 in the bank for my nest egg. Now I've only got $400,000 in the bank for my nest egg, even though it's never realized. But that's just goes through the mind of people, and they're like, "Oh, well, I don't want to."
A lot of people also pull that equity, which fuels the economy. They'll pull their equity and spend it.
There's a lot of, well, especially with the younger, newer home buyers. It's
like an ATM machine for them for a while.
I think that's a lot. That is a lot less this time around.
Okay.
I do, but still, I mean, the reverse wealth effect, as Steve pointed out, is real, and that's going to weigh on sentiment, and then therefore it weighs on consumer spending, and then with all the tariffs and, you know, the higher prices that we're going to be incurring over the next year, it's probably going to weigh on the economy over the next couple of years. So there's not, I don't think we should, you know, that's anything that should be really disputed. So, and stock prices will probably reflect that in the longer term. That's why I think that we may have really put in a longer term top in equities, and it doesn't mean that the S&P is going to 1,500, but you know, we could probably continue to see a correction in U.S. equities over the course of the next year or two.
By the way, speaking of that, we have a friend here in the webinar writing, Steve, also in the Middle East. A friend owns a medium-sized cement production business. He says this year's sales are extremely low. That's what our friend is writing here in the webinar.
Yeah, I would assume building is going to come to a screeching halt in places like Saudi Arabia or, you know, the Middle East, China, U.S. is going to, you know, same thing. So anyway, hey guys, I got to get hop into the market. So good luck today.
You too, bro.
Talk to you later, Blake.
Bye.
Bye, mate.
Steve.
Hello, Steve's plural.
Hello, Stelios, if you want to be exact.
A couple of things before you start, if I may. First of all, I'm going to elaborate a little bit on what Blake mentioned earlier, which is Trump's interesting comments last night. And I am not talking about Stormy Daniels. Let's leave that aside.
Yeah, indeed.
He actually said,
leave her on your side, buddy.
Yeah. No thanks. No thanks. So he said yesterday in an interview that he thinks that the Fed is his biggest threat, which was interesting because, you know, he thinks he's being very vocal. He thinks they're raising rates too quickly. And he actually even mentioned about Fed members, and he said about Powell that, you know, he's relatively happy with what he's doing. You know, he actually said, I put him there in that position. Was I right? Was I wrong? I don't know. But this is what we have. So a few interesting comments from Trump. And it's, you know, it got me thinking, if he doesn't think, if the Fed is totally independent and anything he says will make zero difference, why say all this? You know, there is a reason with what Trump does and with what all politicians do. And, you know, I am a little bit cynical.
First of all, you're forgetting a lot of stuff here. Not only that, Stelio, but within a few days, he has actually called the Fed crazy in 2 different languages. He has used both the term crazy, the Fed has gone crazy, and he has even said that the Fed has gone loco. So he has actually called them crazy in two different languages. Yesterday, he said the same. He mentioned Powell as well a few days ago by saying that, you know, I don't agree with what he's doing, but I'm probably not going to fire him. You know, when you say about somebody, I'm probably not going to fire you. First of all, he can't fire him without having, you know, a very, very, very good reason. And by good reason, of course, we don't mean I don't agree with your monetary policy decisions, because that's what he's there to do. But that by even saying that, first of all, because Trump is very outspoken and very, very, very few times he even thinks before he writes something, because he acts very emotionally. We've seen that, you know, in a plethora of occasions. Just by even mentioning that I'm not going to fire him means that he has asked about it. He has even thought about it. You know what I mean? And you can imagine what kind of what kind of a crisis we would have if actually Trump ended up like firing Powell because he doesn't like the monetary policy. Let me also stress out once again, without getting at all political, I'm just, you know, I'm not an American, I'm not voting Democrat, I'm not voting Republican, I will never do. I mean, I'm voting a totally different country.
You sound like an American.
But
at a Euro stand.
I've said that many times. I agree with many of the things that candidate Trump was saying. And, you know, he has made a 180 degrees turn in the vast majority of those things that he has said. One of the things that he was saying as a candidate was the fact that the Fed was being very political for keeping rates as low as it did, and that was blowing a bubble in the economy. Those are not my words, although I agree with them. Those were the words of candidate Trump. Now Trump is the president, and by seeing the Fed do what he was accusing them of not doing previously, he's unhappy with it. So, you know, go figure, right?
Yeah.
I mean, it's obvious why, but, you know, I'm just stating facts here.
Yeah, and the other thing which we you know, it's worth adding is, like our friend Martin is actually saying in a comment. He says that, you know, Trump has already aligned himself with the equity markets, right? Every time we would hit all-time highs, he was gloating about it. And now, if having said all these things about the Fed, if the equity markets drop, then he's going to say, oh, I told you, you know, you're killing the equity markets, you're killing the markets by raising rates too quickly. So it's maybe he's covering himself a little bit. But anyway, you know, enough of
before we go to the charts, because to be honest, besides the equities, it's not that we had much happening, but I'm going to cover everything. Don't worry about it. I'm going to make one last outsider comment about it. If you remember, I mentioned, and I'm sure Dale remembers it as well, and, you know, our frequent listeners, I mentioned extremely early, many, many months ago, that the fact that Trump is trying to claim victory on the economy after just being a few months a president, and without actually having structurally changed anything in the issues that the US and not only US economy have is going to be his own undoing. That's a huge mistake that he did there, because as a candidate, he was saying how many structural issues the US economy has, and how the numbers are not actually not depicting the real strength of the economy, and how huge issues are underlying what you see just by looking at some of the popular numbers. And after a few months being head of the government, he's now claiming that the economy is booming, it's better as it ever was. So when actually the economy turns down and it goes into a recession, which it will, while he is president, I'm 95% sure, he's going to be blamed 100%, although he will only have a very small part of the blame. Because, as I said, I'm objective. I'm not a Democrat. I'm not a Republican. Trump is doing some things that are wrong for the economy. He's doing some things that are right. For sure, I believe that we would have already been in a recession if Hillary was elected, not for any other reason, because Trump decided, in order to kick the can down the road, he decided, in essence, to blow up the deficits even further by concurrently increasing public spending and cutting taxes, which might help him, and that was what he was hoping for, get another 4 years without a recession. Personally, I believe that that's not going to last more than this effect is not going to last more than a couple of years. So I still think that the economy is going to blow up in his hands, and the vast majority of the problems that will bring this is not going to be his fault, but by claiming victory and claiming that this is his booming economy, he's going to be 100% blamed. So I think that was a strategical huge mistake. That's my opinion about it. Okay, so back to the charts. A few things. Let me go briefly through a few things. First of all, in case you didn't see, we posted, I promised yesterday during the webinar that there's going to be a follow-up blog post to the initial one that Blake had done. And if you go to ForexAnalytix blog, this is free for everybody to read. There is our latest blog post. US equities have rolled over, but is this the market top? We mentioned here the vast majority of the indices. I really suggest that you go ahead and read it if you haven't already done so. Other than that, let me say once again that, in my opinion, cable is still consolidating between 130 and 133, and you shouldn't be trapped by trying to pick a direction, because everything between those two levels is noise, as I've said multiple times. Obviously, the fact that the USD yen is rebounding from this ascending trend line, Blake was the first one to indicate its importance, is quite important, but so far the rebound isn't at all impressive. Personally, as you'll see the details having to do with indices, I do believe that any kind of rebound that we're going to see is going to be in the short-term corrective, because I do think that this move lower, despite having more chances of being a larger correction, is going to end up being a correction, but that does not mean that within a few days the move is over. So I do believe that the market, and actually yesterday in the blog post, you're going to read it, I indicated that the first level to watch if we actually break through 2790 is going to be 2815, which is actually more or less the high that we saw yesterday. So 2815, unfortunately, I was complacent. I slept quite early yesterday. I was waiting to see how the Asian session is going to go, so I can initiate and I can start building up once again a short S&P position, because the previous one, worked out perfectly for me. So I would start building like probably 1/3 of a position at 2815. But unfortunately, I fell asleep. I never put, a trade there. Of course, nothing I can do about it now. I'm just hoping that we're going to see one more leg higher. So I would be hoping that we might find support now at 2790, perhaps see one more push higher, hopefully as close as possible to 2850, because the closer we get to 2850, the more comfortable I will be feeling to build a bigger position for at least one more leg lower towards at least this horizontal support area at 2690. So I still believe that there is more downside left for the indices. You can see it in the S&P. You can even see it in the Dow, by the way, found support perfectly in the broken triangles resistance. This time it acted as support. You can see it in the Nasdaq because we have broken below this ascending wedge, and I do believe we got close to the 61.8. I also believe that the Nasdaq should produce at least one more leg lower towards at least, I would say, the 61.8 from the wedge's bottom to the double top that we saw. The DAX is also behaving amazingly because it found support. I indicated on the webinar that this is a nice confluence of supports. It was a horizontal support area and also the 161.8% extension of the last rebound higher. And, no surprise, it came up, it retested this broken neckline at 11,800, and it seems to be getting rejected from here. Knowing how tricky the market is, I wouldn't be surprised even if I saw another leg higher, to break back again within the head and shoulders formation, because that's going to get a lot of people confused. But I would still be looking to sell such a move. I do think that there is a strong structural damage that has already happened in the DAX. I mentioned also what was it yesterday, the day before yesterday, or whatever, that a rebound in the FTSE should find some resistance in 7,100. Actually, we stalled there yesterday. So far, we haven't been able to penetrate through that today as well. So what's this level as resistance? If we finally break above that, I think that the next level is 7,250. Nikkei got trapped once again within this 22,000 and the 23,000 zone. But the fact that we falsely broke to 27-year-old highs before actually coming down in such an impulsive fashion, I think it's a very bad omen for the bulls, and I think that the 23,000 level might prove very hard to crack once again. I would be extremely careful here. I wouldn't dismiss this move lower as a correction that's already over. I think the momentum of this move, and as I mentioned before, the false break higher are quite a lethal combination. So I would be very, 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 very careful. I doubted that the index is done. So I think that covers the vast majority of the indices. Now, having to do with the euro, I've mentioned that before. As I've said that, there is a lot of noise happening in the cable between 130 and 133. I think the same situation applies to the euro between 114.50 and 118, roughly 118, 118.30. If you look at it, with the little exception of a few days that we actually probed below this 114.15 area, we've spent it's already like 5 months, right? Just chopping around in this area. So the euro does look heavy at the moment, and I wouldn't really rule out. I mean, if you asked me where the next move is going to be, judging on what I'm looking at the chart here, yeah, it has more chances of being lower once again, perhaps towards 113. But we're still trapped in this range. So I think there are better opportunities out there than just try to trade the euro against the US dollar or the pound against the US dollar. So I know that there are a lot of people that like to trade very, very few instruments, and some of them manage to do that extremely successfully. But personally, I'd rather stay away from things that are not that clean and trade things that look much easier to read. Speaking of which, what hasn't changed here is the fact that the Aussie remains bearish, right? Because no matter how many attempts it has made to actually rebound, it every time manages to stay below this descending channel's resistance. It found overnight resistance once again in a horizontal support resistance area that dates back quite a lot. So far, we're seeing like the attempt of an outside black candle. So, the Aussie looks like it's definitely not ready for a strong turn yet. We would need to see a lot more evidence. I would need to see a daily close above this channel and the 50 DMA, which is, by the way, as you see, it's very closely following this channel as a resistance. And some definite change in the in the momentum that we're seeing in the rebounds. The Kiwi might have looked for a few days a little bit better, but despite that, it still hasn't managed to also clear the equivalent channel. Keep also in mind, and mentioned yesterday as something important, the Aussie Kiwi was looking like it might have actually made the move to break below this horizontal support area at 1083, 1085. 200 DMA is also there. The 50% fib of the move higher is also there. The move higher looks also corrective. So everything points to a very good possibility of a breakdown. But once again, we didn't get confirmation that that's the case, right? Because the zone ended up holding on a daily closing basis. So far, we're holding today. So, I'm looking, this is looking like a nice trade to me, but we first need to get it confirmed, right? So, in my opinion, don't jump the gun. We need first to, to see some evidence that, this is happening before actually we get, something more. Now, having to do with the Kiwi yen.
Steve,
yes, Telio?
Steve, just one thing before I forget. Okay, after you're done with the yen pairs, our friend Jacques is asking about dollar USD NOK. If you can have a look at that afterwards, okay?
I would have anyhow.
Okay,
it was in my plans.
Thank you.
USD SEC as well because we haven't had a look at them in a couple of days. So USD NOK, Kiwi yen, as we were mentioning yesterday, inverted head and shoulders formation on the 4-hour chart. Now you're seeing the daily, of course. Potential of a triple bottom, but before you can call any kind of basing here, the 78.6 also was here in the, let's call it a potential triple bottom. We need to see a break above this descending channel. If we do see a break above this descending channel, I think this is going to be looking like a very nice rebound. I think there's going to be a very nice squeeze. But until that happens, this is just a potential trade under certain circumstances, right? So this is something that I keep in my radar. But in my opinion, being where we currently are, doing something here makes no sense. Now, having to do with USD SEC and USD NOK. USD SEC, first of all, got a very nice rejection from there. The move lower looks to me like it's not done yet. And I think that rebounds should be, if we go down to a 4-hour chart, I think that rebounds should be sold for at least one more leg lower. So I do think that this move lower might prove to be corrected, but I don't think that it's over yet, right? So I think that any move up to 9 should probably produce more downside. Now, having to do with USD NOK, let me switch to that. The situation is a little bit more complex. I expected this rejection anywhere between the 50% fib and the 61.8, which is exactly what happened. I said then that the 820 is quite important. We did clear 820. We saw some momentum to the downside, but I'm not really sure what we're seeing here. This might end up being a triangle before moving lower. This might end up being something else. Two things I can tell you for sure. So far, we're seeing a morning star formation on the daily chart. That's usually a bullish. That's usually quite a strong bullish reversal candlestick formation. But 820 is a level of interest. We might get rejected from that. So I think that the situation with USD NOK is quite complex. One thing is for sure, if you look at the long-term picture, we still remain within a large descending channel. And, this might evolve in a few different ways. One of them is going to be something like this, right? And perhaps one more leg lower then, so a triangle. One other way that this might play out is get a rebound a little bit higher somewhere here, then one more leg lower. In any case, I would like to see a tag of this 8 level before perhaps then seeing another move to the upside. So I would still maintain somewhat of a bearish bias, but I'm not sure you should be selling down here. The level to be selling, as I had mentioned multiple times, was here, because the reward to risk ratio was extremely good between the 50% fib and the 61.8. Now, if we're talking about what you should be doing here, I think we need more price action to decide on what kind of a consolidation or correction of the corrective move lower, because there's a good chance that this move lower is corrective. But so far, I see the potential 5 legs lower, which means that it's going to be a bigger correction, right? So more price action. So we have to speak about it again in a few days when we have more evidence of what is actually playing out here. Stelio, did we have any other question that I didn't cover? Oh yeah, USD-ZAR. Thank you very much for reminding me, because I've been monitoring USD-ZAR very closely, and the reason I've been doing so is the fact that we have a head and shoulders formation here. It hasn't been triggered yet, but it is a very clearly defined head and shoulders formation. So the situation with USD-ZAR is quite simple. It got rejected from a very nice, I had pinpointed this confluence of resistances up here. It was the 61.8% of this move lower, and it was also the 127% extension of this move lower. So very nice rejection from there. And now we seem to be approaching we're very, very close actually to the neckline of a very nicely built symmetrical head and shoulders formation. So one thing I have to say about this, a break below 14 seems to be triggering a head and shoulders formation, which I've already drawn that here if you see, because as I said, I was very closely monitoring that. Assuming that we break below 14, the target of that head and shoulders formation is roughly at 12.45. So USD-ZAR, quite an interesting trade to monitor. Not there yet, not ready yet, but definitely something to watch, something that might start playing out even within a day or two, right? Just a fast mention, because I haven't done so in a few days, having to do with the USD CAD. Nothing has really changed for the USD CAD. This move lower has all the characteristics that you expect in a corrective move, all of them: slow, overlapping, choppy, channeled, right? So is it done? We can't be 100% sure, although I can tell you that the rebound we got from this horizontal support area here at 128 and just below the 61.8% fib has a decent potential of having been a low. Obviously, as in every case, you would need to see a break above and the daily close above this descending trend line resistance to feel more comfortable that another leg higher is unfolding, in which case I would be looking for a move towards the 136 area. Coach, do we have a guest today?
Oh, we do.
Okay, is your guest here?
Yes.
Perfect. So I think I'm done, giving an outlook of the markets. So if your guest is ready, I wish you a very nice interview, and I'll see you all tomorrow.
Thank you, Steve. As always, great coverage of the board. One of the best in the business at taking the whole board and crystallizing it for our community. Thank you, buddy. Okay, Arnaud. Looking forward to meeting you, buddy, my trading warrior brother. I'm making you the presenter, so we should be able to see your screen, hear your voice, all on a drop-down menu. Oh, that's a nice scene.
Good morning, Dale. Can you hear me?
Yes, Arnaud. Comment allez-vous?
Très bien, merci.
Oh, je suis fromage.
Oh, it's just...
All right, that's as far as, see, that's my second language. French is my second language. Anyway, great to meet you. Thank you so much for coming in.
Likewise, thank you for having me so much on your show. I'm really honored, and let's see what we can talk about today.
Yeah, and everyone who's here, Arnaud really likes interaction during his interviews and any kind of webinar he does. So feel free to fire your questions as we go through some of the looks and views that he gives us. But where I'd like to start, beautiful family, Arnaud,
Thank you.
How did you get started? You know, what were you doing before you became you know, a trader, an analyst, whatever your business model is? Looks like you have a subscription service. Who do you blame for getting you into the industry?
I can only blame myself.
All right, well, that's good.
Well, like everybody else, I got, of course, interested in the stock market when we got the 2008, 2009 you know, big crash. I'd actually already been investing when I started high school, believe it or not.
Wow.
Yeah. I somehow convinced my parents to not put some of my allowance in a bank account, but to buy some, you know, I would say mutual funds, like you know, like a SPY or something like that. It was more like a Vanguard type of bank account, and that went quite well because that was early 90s, and you know, by the time I was done with high school, which was around 2000, so there was a big top in the market. I actually took my money out because I needed to go to college. Believe it or not, my timing was good. All the time, of course, in college, I wasn't really interested in the markets. You know, it's more about drinking beer and chasing tails than anything else. Yeah, and then
best days of our life.
I know. And
where did you go to school? I noticed you live here in California.
Yeah, so I'm originally Dutch.
Okay.
I went to school in Holland, of course.
All right.
I got a bachelor's degree in environmental sciences. I then moved to Sweden to do my PhD and master's, also in environmental sciences. And there I got married to a Swedish gal and moved to the United States about 15 years ago because she was actually a U.S. citizen by birth.
Right.
And I was like, well, you know, I'm highly educated doctor in environmental sciences. California, you know, it's very environmental oriented. Shouldn't be difficult to get a job. Yeah, very green. And you know, believe it or not, I had to start off at IKEA because most companies just have a difficult time evaluating the worth, so to say, of a foreign degree. And at some point, I was like, well, I got to start low. So here I am, you know, doctor in environmental sciences, started off at IKEA. 2 months later, I was floor manager at Home Depot. 2 months later, I worked for a private consulting company, and then moved to a private nonprofit research organization where I worked for 10 years on the environmental impacts of generating electricity in the United States. And well, at that time, of course, the 09, 08 crash happened. I got interested, and I started going into the markets. I got in contact with a guy who studied Elliott Wave, and I thought it was really interesting. His name is Pretzel. He is relatively known, I would say, in the retail investment kind of area of the market. And he taught me a lot about Elliott Wave and how the markets move and Fibonacci and all those things.
So
unfortunately,
you had a mentor.
I had a mentor. Our views started to differ. That he thought it was a bear market after 09, and I thought it was a bull market. So we kind of departed on equal terms because he's quite bearish and I was bullish. I then met Tony Calderon online, who uses objective Elliott Wave, which is more of a true price-based method for doing Elliott Wave than sometimes a little bit more of a hand waving and guessing type of Elliott Wave theory. And he was my true mentor. He provides courses that I took, and he really took my analysis of the markets to the next level.
What's his Twitter handle, Arnaud?
No, not off the top of my head, but
okay. Well, invite. You know, do you talk to him still?
Oh yes, we're on very good terms. Yes.
Well, tell him. Feel free to extend an invite to him. I'd love to talk to mentors too.
Oh,
so,
sure, I will certainly do that.
So, it looked like you know, you were fortunate, blessed to have landed with Anthony Calderon instead of a lot of the junk that's on the internet filled with barracudas, sharks, and charlatans.
Right.
So,
right.
you know, congratulations, your guardian angel is looking out for you. So why don't we get right to it and delve into what you're seeing here. It's a great time to have Elliot Titian, and you know, I'm interested in a cycle I never heard about. Benner is the Benner. He's an analyst. I think he's an Israeli. Is that correct? There's a guy named Benner.
Oh no, this man passed away a long time ago. He published his work in 1875.
All right.
No, I forgot to bring my book where I have some of the background on him. As far as I know, he was a blue-collar man, if not a blacksmith. Please, you know, correct me if I'm wrong. Who found out that there are certain business cycles that the economy has to adhere to. He found several cycles that you can see here. I'm showing. So this work was published in 1875. You know, that's when he wrote his work. I think it's really started being applied in 1902. So this has been around for a long time. And back then, so he already, using 8, 9, and 10 years as business cycles, as well as 16, 18, and 20 as business cycles, he could start to predict when economies would top and would bottom. So here,
so do you agree? Do you agree with his work right now? The box saying 2018, we're at major highs, or can we just get a nice, you know, maybe 10 to 20% correction and blow off again? What do you think?
Yes, that is definitely possible. Of course, cycles can also be a little inaccurate.
They can invert. They can invert too, can't they?
They can invert, yeah, for sure they can. I am not a cycle specialist, but you know, they can also be plus or minus 2 years, right? If this is something that has been forecasted in 1900, give the person a break that we're maybe off by 1 or 2 years. But so let's go over what he predicted in 1875, and look what he got right. So he got 1929 pretty good as a market high. I mean, that's the most famous market high we can ever imagine.
Right.
Then he said we would have a major low in 1933, which became 1932. Well, you know, off by a year.
Good enough.
Good enough. He has the 1967 low, which was a 1966 low. Pretty good. He has the 1987 crash correctly. He has the 2000 tech top correctly. He has the 2003 tech low correctly. So that's, you know, 1, 2, 3. I haven't gone over the other ones. I'm pretty sure.
So about 50%, 60% or higher.
Or higher for sure. Yeah, I would almost say over 90% if you probably go really accurately through it. Then he said there would be a high in 2010 and a low in 2011. That's correct too. You notice we don't have the 2009 low here. Maybe it is hidden in 2011 because I would always say give these cycles a year or two. But again, we get to 2018 for a major high and 2021 for a major low. Now, if we start combining that with Elliott wave, which I can go over for a little in a little bit, we can see that, you know, hey, this might say something. It could also be, like you said, Dale, that this is going to be a 10, 20% correction, maybe 30, and we're going to take off. That is absolutely possible. You know, I'm not going to put this work in stone. There's always a lot more going on. We went through some unprecedented time with quantitative easing, which could have extended some cycles.
Yeah, skewed a lot of things.
It skewed a lot of things, and for the better, I must say. I mean, Nobody wants to go through a prolonged recession. That's not good for anybody. Trust me, I do not enjoy other people's misery, especially when the economy is down. It's horrible, right? It's horrible. I'd rather have a booming
I'm still
economy.
trying to figure out why they call it the Great Recession. It wasn't so great for me.
No, it wasn't great for anybody. I agree. I agree. So if we then go on, there's another, if we use Fibonacci numbers, which are, the series is 0, 1, 2, 3, 5, 8, etc. And here I'm going over the recent weekly digest I sent to my premium members, the ones that are paying for my services. There's an interesting pattern here. If we know of the year 1789, which was a very important low in the market, in the U.S. economy, and 1843 was a very important low in the economy as well, based on the contractive cycles, which is a 50-year cycle, which is close to 55, which is a Fibonacci number. Then we get 1789 plus 144, because 144 is a Fibonacci number. We get to 1933, which matches up again with what Mr. Banner found. Right. Now, of course, it was 1932, but 144 plus or minus 1 years. It's kind of like, give it a break.
It looks like the worst depression was the Civil War. It took over 20 years to come out of it. 26.
Yeah. Yes, I agree. I agree. So then, if we go to 1843, we add 89, which is also Fibonacci number. We get 1932. If we get 1932 plus 89, we get 2021. So there's a nice proportion here that point to 2021 as a major low, just based on Fibonacci numbers and important market and economic downturns and recessions. So if we keep on going, we just add these different Fibonacci numbers to the different lows and highs we've had. We just identified 32, we have 66, and we keep adding these numbers. We get 64 as a high, we come up at 66, 87 was a low. Well, here it is considered as a high, but it's true because it was such a flash crash. It was a high. It was both. We get 2000, which is the tech top. We do 2000 plus 8. We get 2008, which was a market top in October 2007. Again, please excuse the inaccuracy. Then we have 2008 was 5, which is a little bit odd duck. It's 13. There's really any high or low in 2013. So maybe this QA distorted a lot of things. Then we go 2013 plus 3, right? We keep going down the Fibonacci sequence line, which is a high both before Brexit and the US elections. We get 2016 plus 2. We get again 18, which was the recent high twice this year. And then we keep going till we eventually end up around 2020, 2021. Fibonacci based, we're kind of running out of options. And if we kind of keep going with these numbers, we constantly find 2021. Just adding, it's just kind of having fun with numbers. It's not to say this is absolutely true, but when all things point to the same, you kind of start to get the weight of the evidence approach.
It's like confluence from different methods.
Yeah,
giving
exactly.
You the same outcome. Yeah.
Yes, exactly. So this is something that started in 1789. You have an entire Fibonacci sequence pointing to the year 2021, which seems to say we could have a major market low back then. It seems to fit. Now, if it's going to happen exactly 2021, maybe it's going to be 2022. Nobody knows. But there's something pointing towards 2021. So what makes then from a Elliott wave point of view think of what is going on, I can pull up some charts. So the first chart I'm going to show here is a simple 5-wave move of the 2009 low. So it went all the way to 2011. We got our European austerity scare, I guess, right, in August of 2011. The market then chucked along really nice up to 2015. Again, Greece, I think, was in the news back then, supposedly causing this, a hefty correction. And then again, we have a nice 5 waves up, And every time a 5-wave move ends in Elliott wave theory, for those that are not too well versed in it, it will be met with a 3-wave correction. So if you get 5 waves up, you get 3 waves down, which we clearly had in 2015. We had an A, we had a B, and then a C. Corrections in Elliott wave always are lettered, whereas the advances, the 5 waves advances are numbered. So we have a nice clean 5 waves up, possibly from the 2016 low, with a quite classic, I would say, triangle formation here from the top in January of this year for a 4, and wave 4s are often triangles. Right. Now the advance since has been pretty messy in the S&P 500. But if I go to the Russell, the advance has been tiptoey classic, picture perfect Fibonacci. So
that ended with a wave 4 triangle too, up to 5.
Correct. So we have here, we start here, we have the top in January of 2018. We get an ABC triangle here, and then we get a nice 1, 2, 3, 4, 5 waves up. As you can see, so red 1, red 2, red 3, red 4, and then 5. The third wave was 1.618 exactly, as you can see, times the first wave, measured from the low of the second wave, which is within the Elliott wave world, very known Fibonacci extension for a third wave. When that happens, most likely the fourth wave often, not always, but often drops back to the 1.0 extension of the first wave. As you can see, it did exactly that. Excuse the 10 points overshoot, but right? And then we get a nice, weird 5 waves up to the 2.0 extension. This is classic Fibonacci pattern, 5 waves extension. Now you can see the fifth wave is a little weird. It's not really classic 5 waves. It is more of a diagonal pattern. I only actually can count it into 3, which is a little weird, but if we say,
could it be an diagonal?
It could be a diagonal, and all a fifth wave has to do is simply make a higher high. I'm not too keen on trying to put mathematics to diagonals. People say it has to be this or that, but diagonals are, I find, really weird animals that often end up with a collapse, which we've just have seen back to the origin of the triangle pretty rapidly. So that tells me this is a triangle.
They're terminal patterns, right? Yeah. Okay.
Yes. Yeah.
I'm an amateur. I'm an amateur Elliotician. You know, I have an Elliott wave joke for you, Arno.
Oh, okay.
Do you know why Elliott always waved? He was always waving. You know why?
No.
He was impulsive. And but his wife kept him in check because Mrs. Elliott was corrective.
Excuse me.
You could use it. All right.
I could certainly use it. So this also again shows we had a 5-wave terminal pattern of this year's low, which suggests this move of the 2018 lows in April has terminated, which we clearly are experiencing. Now, the question is, are we going to get a larger bounce and then a further drop? So that is always a little bit the question. There a lot of uncertainties remain in predicting what the market is going to do. But this is clearly playing into the idea that this, if we go back to the S&P 500, this fourth wave has finalized, even though the advance in the S&P itself is sloppy. Now, the S&P is a hybrid index. It's kind of a combination of the tech and the Dow Jones. And that I always find, therefore, to be the most difficult index to Elliott wave count. Whereas tech, like the Russell, which is more small cap, is often very nice and easy to count. And the same with the NASDAQ 100. It counts really nice. Here we again have a fourth wave triangle pattern. This is actually called irregular running flat, where the fourth wave, since this is such a strong bull, was not able to actually move further lower than what we had in February, back in late March, early April. Just the buying power is so strong that the bulls just stepped in and went like, okay, this is just a fantastic level to buy, which is around 6,300 on the NDX. You clearly have a three-wave pattern up, ABC here, and then you kind of have an ABC down. And again, we see a nice standard pattern for a third wave, the fourth wave, again, exactly like the Russell 2000. And then here, again, we get that ending diagonal. Normally, the fifth wave would have ended here, just like it did for the Russell, right, with the 2.0. Well, so here I can go through. You can go on my website, go through my daily updates, which I've all archived.
You have nice content.
Here,
I've been there.
Oh, thank you. And then the market started to do something else. Here you would advise people, while the market has topped, I would go out. I wouldn't necessarily go short, but you can see here we get a nice ending diagonal pattern.
Was that a fifth wave failure ending diagonal up there on 5?
No,
and why the confusion of whether it's the end of 3 or 5, where the other averages you have it being 5 of 5?
Oh, okay. I'll go to the 3 versus 5 in a minute. So that the NDX actually squeezed out a marginally higher high in October. So did the Dow Jones.
By maybe 5 points or 10 at the
5
most.
points. Again, that's all the fifth wave need to do, right? We have this green wave. That's all it needs to do, and that was it. And you can see again, we collapsed right out of the start from this whole diagonal.
Went to wave 4 of lesser degree at the low, and now we're rebounding.
We're rebounding. I can see the futures are down a bit, so this is all as pretty much as expected. So what we here can see, so if we count it this way, it could be a 5 waves up. There is, however, we see, here in 2010, as Benner also said, there would be a high in 2010 and a low in 2011. Maybe this 2010 can be counted a little differently, like this. So we put the big 1 and the big 2 in 2010, and then we have a 1 degree lower first and second wave, and we move up. And now, instead of being at the terminal 5 wave of this bull, we are only at the third of fifth wave. Still does mean we will see a sizable correction that will probably take time and catch a lot of people off guard to buy the dippers. People have been buying the dip now for almost 10 years and start to become complacent. And given that we truly have, as the Russell and the NASDAQ shown, a complete 5-wave pattern of the 2016 lows, we should see a very sizable correction. Now here I've just kind of estimated the way forward. We can use Fibonacci retracement levels to find out how much of a retracement we should expect. And this 4th wave might go all the way actually back to around S&P 2000. I wouldn't be surprised if that's the case, but it's all depends on if this is correct, how bullish the market is, and where the real buyers, the big guys, start to step up again, or when they just really let the market drop lower and scare everybody out of their positions. That's a little bit unknown.
Okay. So say this is correct, and we get this wave 4 followed by a 5 to new highs. How do you project what the 5 could be price-wise after 4?
After 4th, the 5th, there's a few rules.
1 equals 5, or
that's the standard rule. 1 equals 5. Now, in this case, we have a very extended third wave. Normally, as I show with the Russell, the third wave is 1.618. Here we have a massive extension. This means the 5th wave is not as long and could only be as long as the first wave, which is from about 600 points. So let's say we're dropping to 2,400 or 2,500, then we would see a top at around 3,000, 3,100. That's it. Okay, so it's just going to be marginally higher above the 2940 peak we just saw. Maybe 60 points, maybe 160 points. Nothing really I would bet my portfolio long-term on. As we know, and you mentioned, 5th waves can also fail just by a few points. So if
they could also they can also morph into something parabolic too. How will you know you're wrong if we start trading over 3,100? Because I interview a lot of people that use Elliott, and I actually know of one who thinks that after this pullback, we could see 4,200 in the S&P.
Oh, okay. Yeah, I'm definitely not in that camp. I'm sure we could get there.
Yeah.
For me, it doesn't line up with the bigger picture Fibonacci extensions. If we would use Fibonacci extensions, as I said, the market does need to move according to these patterns. As you can see, it really listens to them, because this is what we as humans, I think, would say is beautiful. Like, for example, the ideal hip waist ratio for a woman is 0.618, and right. So this is something that we think, and this is how our sentiment moves. There are nice Fibonacci extensions on the bigger time scale at around 3,050 to about 3,250. Where if we would go to a fifth wave, I would get really cautious when we start approaching those. I never believe in moonshots. I never advise my members to invest for moonshots. I actually already in September, if I go to my website, early September, I already told them we are approaching a larger market top. If I go to my weekly digest archive.
You have any view on, some things that might run counter to it? Some people think it'll go together, like gold and the dollar. Any quick views on those?
I am of the believer that gold and let's see here, the dollar. Let's see if I can find it there. Move in opposite directions. If I take here the data since 1980, we clearly have most of the time when we see a dollar up, gold down pattern, and in red, the dollar goes down, the gold goes up. It's quite obvious there is this inverse pattern. There's sometimes no clear relationship for whatever economic reason there is. Not every relationship works 100% of the time. That's just the way it is.
Holy Grail.
Yeah, Holy Grail. What I am seeing in gold is the following, if that's of interest to you. And I'm going to use GLD because that's the one I personally trade. I actually just sold mine.
Interesting.
Why? Because I think we just did a fourth wave correction. Again, we have a nice, I actually thought, well, let's for once believe in my own work and sell a little bit here for a profit and see if we can maybe buy it lower. This is kind of it doesn't have to be. We could have just a simple three-wave decline and be done. But I really would like to see it start moving over the 200-day simple moving average. That is, I think, always the key cutoff for a bull or a bear market.
Do you think that after we take out new lows at C, that could finish off the bear market that started, I think, in 2011 or 2012 when gold was 1,900?
Yes, I think that's going to be a very significant low. Very significant.
Do you have a number in mind?
Of how high it would go?
No, the lows. Under 1,000?
Oh, for gold? Yeah. I guess. I follow GLD. Sorry,
it
one
trades at a discount to gold.
Yeah. But around there, so slightly below the August low for gold.
Okay.
So around 1,000 plus, I guess that would be it. Don't sue me if that's not the case.
No. I'm not. I wouldn't want you to have to go back to Home Depot.
No, thank you.
Why don't you show? You're doing okay, and why don't you at this time, show your website again, Arnaud, so that people know how to get a hold of you and follow you.
So my website is called investingintelligent.com. This is where I post about once a week or every time I feel some urge for it, free updates to people. Anywhere from here, for example, how does the market respond to when the Fed raises the rates? Well, every time it did, it pretty much caused a market correction. And here we are again because it raised its rates in September. Darn it, Fed, stop doing it. You can reach me also on Twitter at Intel Invest. I have a Facebook page. So here is my address at Intel Invest.
What do you charge for your premium monthly membership?
Oh, right now, let's click on that one. I charge $49.99 per month.
Reasonable. Yeah.
This is, I think, very reasonable. It's definitely one of the lowest out there. The first week is for free. That's when people can kind of see if this is what they like. They can, of course, also go through my daily market archives and the weekly digest archives, which are published the weekly ones a month later and the daily ones 3 to 5 days later. Because I do want to give paying members, of course, firsthand information. And I follow pretty much everything. I do also follow the European markets, the Asian markets, gold, bitcoins, everything, because everything adheres to the same principles.
You have an Elliott Wave view in Bitcoin. Do you think we bottomed?
I do. I post Bitcoin updates. Let's just go into my premium member updates so people get an idea of what I do. So here we have market updates that are updated about once every week. Then if I go to Bitcoin, my most recent, so I follow Bitcoin, the Bitcoin Investment Trust, as well as the NYXBT. This is from 10.8.
Triangle wedge, and you're looking for an upside breakout out of that formation.
Yes, I certainly do. I was certainly looking for lower prices, but if we can get a nice, serious breakout over this trend line, it would suggest that we may have patterned for a bigger C that just failed to break down critical support down to 2,000. It is always still possible, but I don't know what Bitcoin is trading at right now. I do it once a week, sorry, because actually it's not such a fast moving. It's nothing. It's like an EKG of a dead guy, and then it gets an electric shock, and it like Frankenstein on Halloween, and he pops up, and you get extreme volatility from a coma. So yes. You like that? Yeah, that is exactly what it is.
Let me wrap it with one thing, okay? And it's not market related. Your degree, your background in environmental sciences. Do you believe, like with all the hurricanes and weather and everything that we're having, are you a proponent of global warming?
I'm certain that global warming is occurring. I am uncertain about the degree of mankind's impact on the warming we are currently experiencing.
Okay, because I know some guys that are looking for exactly the opposite of potentially moving towards a mini ice age in 10, 20 years.
It is possible. I don't see it in the data. What I do see in the data, for example, is that the number of hurricanes, etc., has not increased over time. It's certainly, if there is any pattern, it's definitely not the pattern that has been predicted by models. But as an environmental scientist, models is not really science. It is, collecting data that you then put to the test by analyzing it to prove your theory.
Like Elliott Wave.
That's one of the reasons I like the market. The market is all about data. So I'm not a rocket scientist. I'm an environmental scientist. But the bottom line is I'm a scientist. I have the technical mindset of number crunching and pattern recognition, especially in environment. Environment is a lot of pattern recognition. Right? Do we see patterns in weather, in changes in climates, in ecosystems, etc. Or that's what I'm kind of doing here. And Elliott Wave is all about patterns and recognizing patterns beforehand, so you can have a little bit of an edge.
You know what else? You know what else you are, Arno?
No.
You are now my trading warrior brother.
Oh, thank you so much, Dale.
You're in the club. You've survived 30 minutes with Dale Pinkert. Not an easy thing to do. I told you we'd have some fun. Did I lie?
No, you did not. We really had a good time.
Yeah, and really, thank you so much for sharing some views that, there are a lot of people with Elliott have a lot of different views, real interesting with how you tied together the Benner cycle with fib numbers, and it was really interesting, 2021. So I hope that pips and dollars rain down on you during this time frame from now on into that key date of 2021 and afterwards. So thank you for your time today, Arno.
Thank you so much. Thank you for having me, and I hope you all learned a little bit. I learned again and had a great time. Thank you.
Okay, everyone, that's Arno, and you follow him on Twitter at Intel_invest, and go check out his website. It's got some great articles. That's a wrap for me, everyone. And by the way, Arno, Tony Caldero's Twitter is at OEWTony. So I'm gonna maybe put out a tweet to Tony. So good hunting, buddy, and
Correct.
See everyone tomorrow.
Much.
Remember, don't just count your pips, count your blessings. See everyone tomorrow. Adios.
Have a great day. Thank you very much.
Thank you, Arno.
Bye.
Bye-bye.